It might be stating the obvious, but you generally invest in stocks and ETFs because you expect them to increase in value. But of course, that increase isn't always going to happen. What can you do when you think there's potential trouble on the horizon, or perhaps even after some of the trouble has begun? One of the most common ways to mitigate the risk of a decline in value of an underlying asset, such as a stock or ETF, is to wrap it with a collar using options. Why is a collar so popular? Because you can protect your investment from downside risk for little or no cost, provided that you're willing to give up all of the upside potential above the short call strike. The collar has three parts. You own stock, you buy a put, and you sell a call. So there's a few moving parts to this strategy. First, there's the underlying asset you already own, such as stock. Since options typically represent 100 shares, you'll need to own at least 100 shares per collar for this strategy to work. Second, to avoid a loss with your investment, you need to buy a put option at a selected strike price below the current underlying price, commonly referred to as out of the money or OTM for short. This marks the floor at which you have the right to sell your stock. If the underlying moves lower, the profits from the put can help offset the losses from the falling underlying. The third part is to finance the put purchase with the sale of an out-of-the-money call option at a selected strike price that is above the underlying price. And this price marks the ceiling. Depending on the call option you sell, the premium received can finance all of or a portion of the put price. When you sell a call option, the premium received from that sale is yours to keep no matter what. This is like letting someone else pay you for your protection. Selling this call, though, means you are obligated to sell your stock at that strike price, the ceiling. So you have to be okay with that possibility in exchange for getting protection for your stock value. But you can always close out your short call before expiration if assignment is not desired. Here's an example. Let's say you purchased 100 shares of stock at $100 per share. A 45-day put option with a 90 strike is offered for $3. Since options are priced on a per-share basis, and each option typically represents 100 shares, it's going to cost you $300 to buy this put. To offset this cost, you can sell the 110 strike call for $2.80. That brings in $280. So, the net cost of this collar is 20 cents per share, which is $20 for your 100-share position. Once the call and the put are in place with the stock that you already own, then the stock is collared. So once the position is in place, what's the worst that can happen? If your stock tanks, the put option provides a limit to your potential loss, and the call option expires worthless, so you don't need to worry about it. Your maximum loss is the difference between the stock purchase price and the put strike price, plus any debit paid or minus any credit received. So, here with the put being $10 below the purchase price of the stock and the collar costing 20 cents, the most you can lose is $10.20 per share. Let's say for this example that the stock goes right to $111 at expiration. The stock profits $10 with the assignment of the 110 call while the put option expires worthless. Factor in the 20-cent net option cost, and the final tally is a $9.80 per share profit. So, the maximum profit is reached at expiration when the stock exceeds the call strike price. One additional thought to keep in mind is that just because you've chosen a certain set of strikes, it doesn't mean you can't change things around. In fact, experienced traders routinely adjust their collars to market movement. To learn more about the collar and other strategies, visit the OIC website, optionseducation.org.